4 months ago, I started this investment portfolio over on Trading212, where I'm aiming to build up my portfolio to £10,000 by handpicking companies and seeing whether buying quality companies at a good price can outperform the market. And so far, it's been going pretty well. In the last episode, we added more to the portfolio, and here is where we're at. £150 in the pets retailer Pets at Home, £150 in Greencoat UK Wind, an investor in UK wind farms, £150 in AG Bar, the makers of the legendary Iron Brew, amongst other brands, and £100 into Airtel Africa, who operate telecoms and mobile money services across Africa. We also picked up a couple of free stocks in Amazon, Airbus, Google and Meta, but we'll touch on those a little later. I also put £50 into VWRP, the Vanguard All World Fund, which will act as my benchmark to see how the stocks I've picked are performing compared to the market. So the total investment at this point is £600. Last month I was also travelling for the month, so I didn't get to buy as much as I wanted. So I took the opportunity to top up with a couple of £50 extra going into Airtel, Greencoat and AG Bar while they were down. So in total we're 3 episodes in and £750 into the portfolio. Let's see how we've been doing so far and get the next lot of buys underway. Now, one of the biggest issues I face with this portfolio in particular is keeping an eye on it. With buying an index fund, for example, the idea is you invest, set and forget. But with stocks, I need to be actively monitoring the companies, where I'm at, where my price targets are, and monitor the latest news that could have any impact on the company. Because of this, I need to be selective in who I'm willing to keep. This is made somewhat difficult by the free shares that I get from Trading212, as they're pretty good, which when I see them I think, ooh, I want some of that company, but I need to be a bit more logical. I'm going to aim to keep this to a maximum of 10 to 15 companies for now. We're currently at 8 already, one of which I may be ditching shortly. What I've done is create a simple spreadsheet with the companies I've bought, and don't worry before you panic trying to pause the video, I will leave a link to this in the description for you to download. So I've got my companies, their current share prices, target share price, and I've added a column here for next month. What this will do is allow me to see if the price target has been lowered, what the general trend is it up or is it down? And the more months I'm able to gather this data for, the more I can kind of gauge the general direction the analysts are predicting. I've also added a column for the potential upside of the company, i.e. how much the stock could go up, and included a column for the dividend. You'll notice there's a few companies that don't pay a dividend here, mainly ones that are purely focused on growth like Amazon and Google and Meta. And of course some, like Greencoat UK Wind, are designed to produce an income, so they have a much chunkier dividend at 6%. I've had a couple of people ask me if the tools I use are worth using, and if I had to just pick one, it would be simply Wall Street. I find it very handy for using it to get this data in a very non-complicated way. All you do is look into the company. For example, Pets at Home, you can go down to value and get an idea of the company's valuation. There's this valuation here, which is something called discounted cash flow model, which you don't really need to know. It's just one way of working out the value. I tend to find this runs a little high, so I tend to look at what the stock analysts are saying. So if I scroll down to this chart here, I can see a prediction of where it will be in 1 year. There's a high and a low estimate. I always go off the average, which in this case is 412p and 17% from where the stock is today. I grabbed the dividend yield from here too, but remember this literally changes every day as it's worked out using the current stock price, which changes every day. So take it with a pinch of salt. But you can see here if it's been paid reliably or not and how it compares to their peers. I find it very handy for this. If you're going to pay for any tool, it would be this one. But you can get up to 5 reports like this for free per month, so you can do that. They gave me a discount to use if you want it. It changes quite often, so I'll put the best one down below. It's also worth noting that I do post every single time I buy and sell on Patreon, so if that's of interest, it could be worth checking out as it will be much cheaper and you can join our community. And remember, if you have any questions about anything I say or talk about in this video that doesn't make sense, leave a comment as I will reply to those. And at the end of each episode, I'll feature a couple of questions from the previous episode, so look out for yours. Okay, so how have our 4 main companies been doing this month? Pets at Home have not had a great month. They're down 5.5%. This is due to an investigation being launched by the CMA. CMA stands for the Competition and Markets Authority. It wants to probe into whether within the $2 billion industry, vet surgeries are offering customers an adequate service at fair price. They said that the share in independent vet practices, which used to be the majority of the market, has fallen down to 45% in 2021, down from 89% in 2013. I personally think this is more a general shift in the industry. It's obviously worried the market a little. I think if there is a little bit of a shift more towards independent businesses, it's a good thing. thing, but I think the market is a little bit too worried. I think Pet to Home has built up quite a considerable moat in the UK, which means it has made it hard for other companies to compete on their level. The sheer size and buying power of the company would make it hard for any small independent business to compete. The fundamentals look good, perhaps it's just a good opportunity to pick up some more shares at a discount while the market panics. My total holding in Pet to Home is now £140, down 6% since I bought it. And you can see this line here, which represents the price I bought it at compared to the price it's at now. I also had a dividend payment for £3.43, which represents 3.64% dividend payout. This is paid twice per year in July and January. I didn't aim to buy this one for the dividend, but a good bonus to help offset those short-term losses. I mention this every video, but my goal is to hold these for 3+ years. But even so, it's interesting to see how these are performing month to month. Greencoat, on the other hand, has had a pretty nice month, up 3.33%. They announced their half-yearly results, which ended on 30th of June, generating £204 million in cash. They declared their dividends, which translated to a dividend payout of 5.6%. For a very capital demanding industry, they have pretty low debt compared to the value of their assets. This means the company has healthy metrics. Executives at the company have also been acquiring more shares worth over 1.4 million in the last 3 months. Good signs for a stock that is still potentially 19% undervalued. My current holding in Greencoat is £187, which is now down 5.9%, which could represent a good opportunity to buy more. What's great about this one is the dividend it pays. I've had a couple of nice dividend payouts so far from Greencoat. My latest was £2.88. This is still just under 6% and is paid 4 times per year. I want to continue to increase my holding in Greencoat and increase those dividends. I'll also do a tally of how many dividends I've received each month so we can see how they steadily increase over time. AG Bar has had a pretty neutral month and has not really moved too much, but some interesting things have been happening. The company's long-standing CEO, Roger White, has announced his retirement in August after 20 years at the helm. A change in leadership is always a step into the unknown, but it could be just what the company needs. The price has failed to recover from a 2019 profit warning, and now 4 years on it's sitting at just a fraction of the other UK soft drink players like Britvic and Fever-Tree, who are both dwarfed by Coca-Cola on the FTSE. But with strong financials, AG Bar has a good chance to grow its profits after this slow period. With the addition of its new brands like Funkin' Cocktails and some cereal and energy drinks brands, it could be in a good position to grow right now. Management says it expects like-for-like growth of 10% in revenue, and sales are set to rise from the same period last year of 158 million to 210 million this year, which could bring a real boost to the stock. My current position is £190 in this stock and I'm down 4%. Probably slightly less than this when I include the £4 or so I've had in dividends, but I've chosen to hold the cash on account so I can reinvest them when I choose the time is right. Airtel Africa, on the other hand, has had a very good month, up 14.4%. It seems that the market panicking over currency issues has eased, which threatened the company. The company does have some threats in increasing competition, but as wealth levels grow in their territories, demand for telecoms and mobile money services can soar. The total returns to shareholders of the stock have been 117% over the last 3 years. But of course, that doesn't dictate future results. There is huge room for growth within this company, but also potentially some risks to it. I certainly class it as one of my riskier picks. Whether it's a pick I'll regret not buying more of, we will soon see. My position in Airtel is currently £168 with a 12.83% gain. Definitely wish I would have grabbed some more of that one last time. So looking at all of those, how are we doing compared to the market? I said I would do this at certain periods, but I was away last month travelling and I didn't unfortunately get to do it at the 3-month mark. So now let's see 4 months in how we are doing. On the 5th of May was when I started this challenge and I bought £50 worth of the All World Fund. In this period, the All World Fund has done pretty well indeed, which my other portfolios have definitely felt. In this time, the ETF is up 6.12%. Now, if I combine my 4 positions, it totals £686.50. We also need to add in the dividends I've received since I started the portfolio, so £699.35. Which, if we take into account the £700 I put in, puts me at minus 0.09%, or pretty much have gone nowhere. And when you factor in all the time it takes me to monitor these, research them, buy them, the loss definitely wouldn't stack up. I always do preach for index funds, but I think this is still super interesting to do and see the difference between passive and active investing, and I find it so much fun. It also would be pretty silly for me to buy stocks that I'm aiming to rise in a year or two's time and complaining that they haven't gone up in the next month. If that was my goal, I would be better aiming for random companies which had the potential to explode, which is not what I'm aiming for. In theory, stocks that have the potential to do double-digit growth should outperform the market over a longer period of time, but we will see. Maybe when we hit the 10,000 goal, if it hasn't outperformed the market, I'll put it to a vote and see what to do with the funds. Let's see. Now on to the crazy part of the portfolio, the free shares. This has actually been giving me so much hassle to work out what to do with these and how to represent it. What I've decided to do is show the results like I just have, and then a second set of results from the free shares that I think are worth keeping. Any I don't think are worth keeping, I'm just going to sell and keep as cash on the account to use next month. So in total for my free shares, I've had £2,050 worth with 133 free shares in total, averaging £15.41 per share, which I think is pretty generous compared to what I was getting before over on Free Trade when they averaged about £3 per free share. A huge thank you to anyone who has signed up with a link, because now between my SIP, my lifetime ISA and my ISA and this, it's quite a lot to keep up with, and it really does help keep this series going. Last month I eliminated all of the free shares I didn't think were worth keeping and I got it down to just 4. We had £64 in Amazon, £35 in Airbus, £23 in Google and £12 in Meta. Since then, just to complicate it more, I've had more free shares in those companies. Amazon is now £146 with a 7% rise in its share price too. Airbus is now £45 with a 3.71% fall in its price. Google is now £48 with an 11% rise in its price, and Meta is now £61 with a 4% rise. So it seems like Trading212 is better at picking stocks than me.
I'm sorry, Chris, but I am a better trader than you. This is my channel now.
Just kidding. You should see some of the losses I've had on some of the ones I've sold. I'm not sure whether to go through the news for all of these in this video because I know it would be so big, but essentially I've done this and I've ran through the key indicators I use on Simply Wall Street to narrow them down. I'm aware that if I did go through the news, these videos would be super long, but let me know your thoughts. I've added them to my spreadsheet, however, with the targets and their dividend details. Again, the link is down below. Nothing to report from these in the way of dividends just yet, as only Airbus pays a dividend, and it hasn't paid one out to me yet. So since last time, we've gained some more free stocks as well, and here they are on screen now. This is where it gets difficult, especially with all of the shiny logos, because investing should be more about value, not shiny brands that you're familiar with. Trust me, I definitely wouldn't be buying Greencoat UK Wind over Nike and Apple if this was the case. There's been a couple of huge stocks this month, like Louis Vuitton and H&M. As much as I might fancy myself a Louis handbag, I'm not too sure if I fancy the stock. This is where Simply Wall Street becomes super handy for me to eliminate these quickly. So for example, if I open up BMW, although the analyst estimates are good, the value based on the discounted cash flow, which is normally very generous, is very tight here, which is enough for me to just rule them out. Perhaps if I had hours to sift through their stats and latest reports, sure, but at a glance I need to be picky. BP have had a huge rally lately, so I'll get rid of those too. And I'll go through the others now, and done. Here are the ones I've decided to keep. Yep, just one. Apple. I've done this for a couple of reasons. The first is I do want to keep my total companies down, and the second is I'd rather have the freedom to choose the companies I want, so I'm freeing up some space for those. I also think it'll be particularly fun to have a tech section to the portfolio, which could be pretty interesting. Apple has had a pretty interesting time lately, with news surfacing about it being banned in China, but the launch of the iPhone 15 has been one of the most successful in Apple's history, with a 7-week wait time, selling in both the US really well and China, despite being banned. I also like the fact that Warren Buffett owns 5.89% of Apple, making him the second largest stakeholder of Apple after Vanguard, which is huge. I've also added Apple to my spreadsheet so I can track the price targets. I'm not sure whether it will be a long-standing position just yet, but for the sake of having £46 in it, we'll keep it for now. So let's do some investing. I have to admit, I am a little behind schedule due to going on holiday last month and unable to get an episode together as they take so much work. I was able to invest £150 while I was away, but still, to bring this back on track, I'm going to now exclude the £50 that I have in VWRP, so we can get to £200 per episode invested into stocks. Plus, I'll invest £300 more, so we'll have 5 months totaling £1,000. First, I want to add another company, AstraZeneca. A name that might send shudders down some of your spines. But believe it or not, when you look at their performance, not amazing year to date. It's okay over a 1 year period at nearly 10%, and over 5 years they did, well, surprise, surprise, COVID. But what's even more surprising is they actually did very well before COVID was even a thing, and their all-time growth has been astronomical. The company is a UK-based pharmaceutical company, which gives me some exposure to pharma in the portfolio, and it's based in the UK, which is great. The company has 148 different medicines in its pipeline, and half of them are in oncology, which is typically a more expensive drug category with a lot of unmet needs. The reason I think AstraZeneca is able to stand out from the competitors is it invests a significant amount more into research and development, around 22%. The company has now fallen 10% from its year-long highest point, so it's an attractive point to jump in. They have a very healthy 1 year price target, which is nearly 18%, and are estimated to be 20% below their fair value. They also offer a 2.1% dividend on top of this, which could be nice to collect. There's a couple of red flags which I always like to highlight. Their CEO, Pascal Soriot, is now 64 years old. If a new leader came in with a radical different direction than him, it wouldn't be great. Also, a lot of their income is from foreign sources like China, which is around 14%. If more legislation is pushed through in a big initiative to curb big pharma profits, the company could be hurt. Although AstraZeneca does invest so much into R&D, which is what companies want to research into new drugs, it's unlikely to be anything serious. So I'm going to buy £200 worth of AstraZeneca. With the remaining £100, I'm going to do a bit of a top-up. I think the biggest opportunity in my portfolio right now is in Greencoat UK Wind, so I'll pop it in there. Take advantage of the price being down, and that will also help bump up the dividends in the portfolio. I've gone ahead and added each of these to my trading pie. A big thanks to IndieFlow, who made me recheck importing them into my pie was possible, after Trading212 team told me it wasn't possible. It seems it's only possible on the mobile version. To heading to the bottom of your pie, more options, import to pie, and I can select the stocks I want to bring them over. I'll put the links to my trading pies down below. So after that, each of our purchases are as follows. £150 in Pets at Home, £300 in Greencoat, £150 into Airtel Africa, £200 into AG Bar, and £200 into AstraZeneca. Total investment of £1,000, and the current balance is £986, with around £2 of that being in fees, so right now we're down 0.85%. So let's see how we're doing so far. And for a bit of fun, if we add in the free shares to the total, the current total would be 1,412. So it just shows how beneficial those free shares are. I imagine as time goes on, they will play a much smaller part in the portfolio, but we'll see how that pans out. I've also got £800 in cash on the account. The interest rate has risen to 2%, still not huge, but better than nothing. You can see my all-time interest has been a whopping £1, and my daily interest is 3p. But even so, it's nice to see these daily interest payments compared to not having them. And although it's not the purpose of this portfolio, here's how my dividends have been growing by month. In total, I've had £13.29 in dividends. My best month was July with £5.60, but in September I had just 19p and April 0. This will be a little bit hit or miss as I'm not buying purely for dividends, but still interesting to watch as the portfolio grows. I did have a question regarding dividends on my last portfolio from Thomas to do with dividend tax and how it works. Dividends are subject to dividend tax, unfortunately, which is currently up to £1,000 per year. I already tend to utilise this through my own company paying me a dividend, so it's not really great. Although at the moment it's only making £13, which is not a huge worry. I'll just adjust the amount of dividends I have through my company to register for that. Of course, if you are within a SIP or an ISA, you don't need to worry. It's not the most ideal having a non-ISA account, honestly. My plan is to keep this very much below the threshold, and I'll likely move away from dividends altogether, perhaps once it becomes more significant, because it'll be more tax efficient for me to have income from stocks rather than dividends. But I can't envision it being a problem within the scope of this series. Even if I have £10,000 paying a 5% dividend, it will only be £500, still well within the allowance. Jay also asked, is it worth paying for the additional stock analysis tools? Could you tell me more about the signals you use? I don't think it's worth paying for more than one. Seeking Alpha and Simply Wall Street is overkill. Personally, I definitely think Simply Wall Street is more simple of the two. If you're more of a statistical person, you may prefer Alpha. I find Simply much easier to understand, and regular people don't really need it. But if you want to actively buy stocks yourself, it's a no-brainer to get one. I don't know how I would manage without it, it would just take far too much time. Even this video by itself has probably taken close to 10 hours worth of work, not to mention the recording, editing, and so on. I can only imagine how long it would take if I had to manually find all of that data myself. Maybe if enough people want it, I'll do a complete walkthrough of the tool and how I use it, or share more about it in my newsletter, may be a better option. Thanks to you guys for taking the time to watch this video. I've really enjoyed making these despite how much work they take. As always, let me know if you think there's anything I can change or improve on. And before you go, do me a favour and just turn on that little notification bell. I've had a few people complain they've missed updates due to YouTube not pushing out the videos, which is pretty frustrating. I'll catch you guys in the next episode. Thanks.